Huge U-turn forced upon them. Natural impulse of the Fed after a banking crisis, maybe that's too big a word, is to pump liquidity into the system and get things resolved. They've done a lot over the weekend announcing they're protecting depositors. So when I left on Friday, I thought it was going to be a pretty negative Monday, but they've worked very quickly and answered the biggest issues and haven't gone basically into the moral dilemma where they're not protecting equity holders, bond holders, but making depositors whole and committed to not increasing taxes. This isn't going to come from the U.S. taxpayer, they're saying as well.
What we've got, though, when it comes to the banks and the trade on Friday was suitably downbeat, 4% stripped off the banking index, 14.6% for the week. Now we have this special program, Bank Term Funding Program, that effectively allows loans for up to 1 year for banks that pledge some of those U.S. Treasury securities, mortgage-backed securities as collateral. I think as we wrapped up the week, there were concerns around the maturity profile of many of these banks and also whether maybe they'd have to pay up more to attract deposits. How do we think about the sector now? What's the trade?
I still prefer bonds to equities of banks. I don't think there's massive upside in the banks. I think they're incredibly cheap. I don't think there's a lot of growth, and you've got potential mismanagement. You've got regulatory fines. That's something the banks just can't get away from. So the bank debt pays you a significant premium above treasuries. There's risk with it, obviously, but all the regulations, everything that's happened since the financial crisis has been done to put better regulation in place, capitalization measures. All the big banks are much safer than they were in 2008, but memory is long, and investors demand that premium for it, even though I think they're much safer than they were back in 2008.
Patrick, you pointed to what is effectively a more positive sign of things, right? Having seen them work so quickly now to get things sorted. Have we sort of ring-fenced, as you said, the bank crisis being perhaps a too big a word here?
Yeah, I don't know if it is, but they've put the measures in place that it's definitely plausible now that they've ring-fenced this and there isn't going to be a run on other banks who have similar characteristics because they've put in place that depositors will be safe from all banks, basically. I don't think there's going to be a run on banks, but if I'm in one of the less secure banks, I definitely wouldn't want to have big deposits there. Yeah. So I think there will be, instead of a panic, there'll be a transition into healthier banks, bigger banks acquiring smaller banks, things like that. There'll be pressures like that.
But this does offer a kind of a warning, right? Especially in this interest rate environment. I mean, it's the most aggressive stance we've seen on interest rates for certainly some time, at least 2 generations. This kind of gives a sense that you needed to be ready for interest rates going up and down.
Yeah, carry trades work when they work, and when they don't work, they fail spectacularly. And essentially, that's what this was. The bank had 0 interest rates at the front end, tried to get a small pickup by going longer duration, and when your assets don't match your liabilities and liquidity, yeah, it's a big consequence, mismanaged. And I'm sure all banks will be reviewing their stress tests, and regulators will be ensuring they're on top of that too.
Patrick,